We are live now, doctor.
All right. So, hello and good evening to all. I welcome you again for this wonderful series which we are having. The first episode was about introduction about the asset class, introduction to savings and financing and all those things. Today, we are going to have a discussion about asset class introduction. The asset classes are generally divided into equity-based, debt, real estate, and gold. But how we can incorporate in our financial management and how asset classes, how each asset class is different for different goals, such things, and so many other things which we are going to learn. So we have Mrs. Shruti Agarwal and Mr. Vikash Agarwal from CAGRfunds, and they are going to share their expertise on this topic. So over to you, Mrs. Shruti Agarwal.
Thank you, Dr. Nikunj. A very good evening to our audience. And, even before we get into the different asset classes and, how are they different from each other? Why are they suitable? I thought we need to really address that. Why is this topic important? In our first session, we spoke about how savings is different from investing, how compounding reflects, upon practically upon our wealth creation journey, and why we chose asset allocation as our second topic. The reason we chose asset allocation for our second topic is because this actually drives a lot around how we will end up financially, let's say 10, 20 years later. So when we are young, when we are in our late 20s, early 30s, it's very natural to start thinking about where do I invest? What are the best funds? Should I do mutual funds or stocks? Should I take a land parcel? Should I first buy a house? So these are the kind of questions that come to the minds of many young people. And the fact is that when we are young, we are not able to visualize 10, 20 years into the future. And we take decisions based on what is the situation right now, what's our most urgent need, and where do we feel like we'll get the best returns in the next 1, 2 years. So that's how most young people take decisions around investing their money. And this is where we wanted to kind of digress and showcase that why understanding the concept of asset allocation is very important very early in your life. So let's assume that I have 1 crore today, and my major investment is a 90 lakh flat in a tier 2 or a tier 3 city. And this is very relevant largely for people who are starting their career and have worked for a few years, and there is only a limited portion of capital available. So in those cases, deciding where to first invest your capital is a very, very crucial decision. So if we assume this kind of a situation where I have 1 crore and I want to decide my investments, and let's assume that I have kept 10% of my 1 crore, which is 10 lakhs in an FD for any emergency needs, and I've invested the remaining in a property. And the expected CAGR that you see here is basically the historical returns that we have received from these asset classes. Of course, some of these could look debatable, and I'll discuss about that as well in a while. So in 1 year, if I assume a linear growth rate, in 1 year, my 1 CR becomes 1.06 CR. In 3 years, it becomes 1.19. And in 5 years, it's 1.34. And 10 years, 15 years, it gradually grows at a certain rate of return. Now, if I change my rate of return in real estate and say that, okay, you know what, I've taken a better deal and I think my property is going to grow at a 10% kind of an appreciation every single year. So normally real estate returns in the current era for a lot of people would range between 6 to 10%, depending on what's the location, what's the kind of real estate you are doing. And this is relevant for most people. So even if I change this to 10%, we would see that in the first year, the corpus becomes 1.1, and in the 15th year, it becomes 4 CR. So basically, what we are seeing is that the difference in wealth becomes significantly different only if that if that one single property outperforms in terms of returns, and number two, when we think about 10-15 year period. Now, if I change this allocation a little and say that, okay, let me not buy the property, but I have liquid capital right now, and I want to keep 10 lakhs as my emergency fund. And then I want to start investing in, let's say, mutual funds and stocks. And we have taken very reasonable historical and expected future returns of these asset classes. So in the first year, my corpus would be 1.12 CR. But in the 15th year, this would be close to 5.87 CR, right? So what does this mean? Why are we comparing different asset classes and different investment choices? If I if I look at what happens in the first year, you would see whether these are the two different allocations. The first allocation is where I've invested a massive portion of my limited capital in a property, which would which I would expect would appreciate at a rate of 5, 6, 7, 8% return. And in the second scenario, I have allocated a massive portion of my liquid capital into liquid financial assets, which would appreciate at a double-digit rate of return of around 12 to 15%. The difference is not much in the first year. It doesn't matter too much whether this 1 CR is becoming 1.06 or 1.12. But the huge difference is seen when we elongate this time period over longer periods of time, and we think about wealth creation, over 10, 15 years. So the point I'm trying to make is that, if you want to invest your capital for 1, 2, 3 years, it does not really matter whether you invest in a mutual fund or gold or FDs, because it's not going to make material difference to your wealth corpus. But when you're thinking about wealth creation, and let's assume that you're 30 today and you're thinking about wealth creation 20 years down the line when you'll be 50, then the decisions that you're taking today will materially impact how you will end up 20 years later. And this is why capital allocation decisions, asset allocation decisions are very, very crucial early in life, so that you can actually play the long game and take advantage of asset classes which have the potential to give you higher returns and move your wealth needle over a 10, 15, 20-year kind of a period. So this is one of the very famous quotations by Ray Dalio. He says that the most important thing you can have is a good strategic asset allocation mix. The point of the previous slides was not to say that one asset class is better than the other. The point is about, in a lot of our client cases, when we are talking to our clients, we see that either the client has a lot of insurance policies in their portfolio, or they have a lot of real estate in their portfolio, or they have a very high, massive chunk of FD sitting in their bank in their portfolio. So the whole asset allocation is skewed towards one asset class, and there is no diversification, there is no thought about whether this is going to work for me over a 10, 15-year period. So which is why we need to think about all asset classes and also think about how they fit into our journey of wealth creation and goal building and goal meeting our financial goals as well. So we have to, construct a portfolio which is balanced as well as which is optimally diversified. Too much diversification is also not good. So we have to create a portfolio which is well structured in that sense. Now, how do we really make decisions around what products or what asset classes should we choose? There is no one single blanket answer which is true for everybody. Normally, it's a function of these four variables. Number one is your risk appetite. Number two is time horizon. We spoke about time horizon in the first few slides, where we are talking about how do you segregate short-term investing from long-term investing. We look at product constraints. For example, there could be some products which are not as liquid as some other products, or the risk factors associated with different products, and of course, investment constraints. Before we move on to, introducing you to the different kind of product landscape specifically within the Indian universe, it's important to understand one aspect of risk appetite. So basically, risk appetite is a function of two things. One is risk willingness and risk ability. So risk willingness is, basically it shows how much risk you want to take. So it's possible that you might say that, I'm very young right now, and I have surplus capital. I don't have responsibilities. So let me take a lot of risk. I want to take a lot of risk. And risk ability is how much risk you should take because of the circumstances that you are in. For example, in one of our client cases, what happened is the client said that I want high returns, and therefore I want to take high risk. But when we looked at their numbers and their situation, the client had a very high home loan. They had parents who were medically not very fit, and they did not have health insurance. The wife was not working. It was only a single income family. The circumstances were not very conducive to take a lot of risk, right? So both these factors become very important when you think about how much risk you want to play with. Now we'll move to the type of common asset classes, and we'll quickly touch upon each type, talk about positives and negatives, and then move on to product introduction, after which we can actually start taking questions. So primarily we have four kinds of asset classes actually. There's debt, there's equity, gold, real estate, and then there are certain products, certain other products as well. So if I talk about debt, basically these are instruments which are low risk, low return. You will not see a lot of volatility in the amount that you have invested. Examples would be, and I will be talking about examples in a bit, but it would primarily be, PPF, FDs, anything which is very safe and you feel that capital is protected. It's very suitable for allocating only a part of your portfolio to cushion the risk that you are taking. For a lot of people, and specifically even in the medical fraternity, we do come across a lot of doctors where a sizable portion is in FGs, primarily because they are not aware of what other asset classes they should be investing in, what's the risk there, will it work out, not work out for them. So what happens is, if a large part of your money is just sitting in an FD, the post-tax return are lower than inflation, which we had spoken about in the last session. And that kind of just destroys wealth for you. It does not really protect capital. It destroys your capital slowly, because we are not able to visualize inflation in real terms. But over a period of 10 years, that money will not grow at all, as compared to the rise of cost that you would be living in. So it is only suitable for allocating a part of your portfolio. It is very suitable for investors who have very low risk appetite, who cannot, visualize volatility. They lose sleep over, money going up and down. And this is extremely suitable for goals such as emergency fund. Again, I have seen a lot of people who want to invest their emergency funds in a mutual fund or stocks. And they say that, okay, when the emergency will come, we will just sell the stocks. But the point is, mutual funds and stocks come with volatility, and your emergency fund should be something that is typically not volatile. It is very easily liquidated, and it's very easily accessible. It does not reduce in value. So the debt asset class is extremely suitable for that purpose. Now, equity, before I move on to the characteristics of equity, I think I would just want to highlight that what is equity. So equity basically just represents, companies which are doing business and are listed on the stock exchange. Now, why are they listed on the stock exchange? Is because they want to tell the investors that you give us capital, we will do business with that capital, and the growth that will happen because of that growth in business, you will also be a part owner in that growth, right? So when you invest in equity, either through mutual funds or stocks, you are typically trying to become part of businesses that have the potential to grow in the future. And any growth in the equity asset class is because of the fact that the underlying companies will continue to grow. So let's say, there are people who are continuing to buy cars, there are people who are, buying grocery, and all of this continues. There are people who go to hospitals, buying medicines. So if life continues like that, the underlying companies which have a decent enough, grasp over the business that they are operating into are likely to grow further, and that will reflect in the price that people are paying for them in the market, which is basically what equity investing will do for you. Now, when you invest in a business, think about it like this, that you are a doctor and you want to set up a hospital. And if you want to set up a hospital, of course, there is risk, right? You will be investing some capital, and it is possible that the hospital does not do well. So you are taking risk of capital loss. There would be volatility. There could be, it is possible that your hospital was doing extremely well, and then some other hospital came in the vicinity, because of which the demand for your hospital has gone down. Or maybe there has been one or two cases in your hospital which is temporarily tarnishing your reputation. So the demand has gone down. So there could be volatility in terms of business volume. So similarly, when you are part of businesses which are listed in the stock exchange, it is highly normal that there'll be volatility, there'll be risk of capital loss. But the reason you invest in equity is also because you believe that there is growth at a much higher rate in the future, and I will be rewarded for that growth. So you take additional risk as opposed to, let's say, an FD where you are taking no risk. You take that risk in lieu of higher returns, which you expect in the future. But the difference between a debt product and an equity product will be that debt products will generally have linear returns. You will, if you are doing an FD, if the FD return is 6%, you know that you will get 6% every year. In an equity product, that may not happen. You may know that I will get 12% on an average every year over a 10-year period. But every single year may not look like plus 12%. It could be plus 25%, minus 10%, plus 30%, minus 2%. It could be very volatile, right? So it is very suitable for investors who are not looking for linear returns, suitable for investors who have a relatively higher risk appetite, and for investors who are looking to invest for relatively longer term goals. So when you invest in stocks or mutual funds, the idea is not to take the money out in 1 year, 2 years, 3 years. The idea is to let the money stay invested for a longer period of time, so that goals which are 10 years away, let's say child education, or setting up a business, or even your own financial independence corpus, so all of those can be taken care of by investing in equity. Gold is a very known asset class. We have all seen our previous generation also investing in gold massively. But the point is, one of the things that we see a lot of people feel is that it's a very quick money making asset class. That's not true. Gold, again, is a long term asset class. It is very suitable for diversifying your portfolio. So, gold is a hedge for inflation, which means that, normally when equity markets are not doing well, there is volatility. You will see that there's more demand coming into gold, because of which gold prices do well. The difference between equity and gold is that equity represents that the businesses which are doing actual business and generating cash flow in return. So they are selling goods and services and they are generating cash flow in return. In gold, the underlying asset is the commodity. If it's a scarce resource, the gold prices are purely determined by demand and supply. So there is no underlying asset class which is in turn generating cash flows, because of which the gold prices will always be influenced only by demand and supply. So every time there is demand from central banks, so you would see central banks across the countries have been buying gold for the last 1 2 years, because of which gold returns have been phenomenally high in the last few years, right? So it's very suitable to use as a portfolio diversification tool. It is not necessarily a very, very high return wealth creation tool. Also, in gold, one thing that we have seen over long periods of time is that the volatility is lower than equity. So it also merits an allocation in the portfolio by the simple from the simple fact that while equity is volatile every few years, gold has corrected maybe 3 times in the last, I think, 12 to 15 years, massively corrected. So the journey of gold is like it goes up very sharp and then it just remains flat for a very long time. So gold sees more of time correction than price correction, whereas equity sees both price and time correction. So that does have, for lower risk investors, maybe lower risk appetite investors, gold makes it easier for them to start investing and have an allocation there. Real estate, again, very long asset class cycle. Normally, you will see that if real estate is doing well, it does well for 10, 15, 20 years. If it's not doing well, it does not do well for 10 years. The other aspects of real estate is that generally, in order to buy one property, whether it is residential, commercial land, it requires a large chunk of wealth, even for a single investment. So the problem, the negative of real estate is that you end up taking a lot of concentration risk with a sizable portion of your net worth. So when I was talking about asset allocation in the first slide, the reason I took 90% as my real estate investment is because it's very difficult to, it's impossible to get a flat for 20 lakhs, right? So if you have 1 CR and you decide to buy real estate as an investment, you are more likely to spend 80-90% of that corpus in your first investment. And you are not left with a lot of liquidity after that to diversify your portfolio further. Similarly, real estate is less liquid. It's not very easy to sell in a short period of time. So, as compared to other asset classes, debt, equity, gold, all three are pretty liquid. Real estate has an aspect of illiquidity, and usually every aspect of real estate is subject to market So you are taking concentration returns in return for those risks that you are taking. Again, real estate, of course, is suitable if you want to purchase a house for living for your own self. Land and flats have very different dynamics, so it's not fair to compare all kinds of real estate, transactions under one single head. So those are the characteristics of real estate. And within others, they are the lesser established asset classes. For example, unlisted shares, crypto, startup investments, and so on and so forth, where the risk is random and the risk is very, very high as compared to all the four asset classes that we have spoken about. So, those asset classes are normally suitable when you have already created a sizable net worth for your financial goals with the other four asset classes, right? I have seen a lot of young people say that, okay, I can take higher risk, so let me invest a little bit here, a little bit there. But normally that's not going to move your wealth needle like we showed you, right? So if you are invested a little bit everywhere, there'll be some things that will do well and some things will not do well. So on an average, your portfolio will not move significantly. But if you're able to devise an allocation where you're able to identify a meaningful portion of your capital being invested in high growth and a considerable portion of your capital being kept for cushioning, shorter term goals, etc., you will be able to see meaningful impact on your net worth over a 10-15 year period. Now, like I said, we'll quickly go through the products. Debt is basically fixed deposits, recurring deposits, EPF, PPF. You have debt mutual funds. Even government bonds are there. It's called RBI bonds. Currently, they are giving around 8% per year. They are floating rate bonds. But all of these, again, normally we see that they don't occupy a very high proportion of investments for people because all of these are taxable. So if you are in a 30% tax bracket and on a low return of 6, 7, 8%, you get a 30% tax rate, the net return is very, very low. So again, all of these instruments are suitable for a portion of the net worth where you want to, where your objective is either emergency funding or short-term goals. By short-term goals, I mean any purchases that you have to make in the next 2-3 years, or you are looking for, you're taking risk on some part of your capital and you want to not take risk on a portion of your capital. So it's only suitable in those cases. These products do not merit a very high proportion of your net worth, because if they do, then overall your wealth will not be able to beat inflation at all, irrespective of what product you are in. There are also corporate FDs, corporate bonds. Now, here I would just like to highlight that there will be a lot of advisors in the market who would tell you that, sir, आप ये debt product ले लो, इसमें 12% का yield है. And, from your understanding, you would say that debt is safe. So let me take a 12% return on debt. Now, no extra return comes without risk. So in a lot of these debt products where you are getting higher returns of 10, 11, 12%, you have to understand that the risk is coming from the fact that you are taking a credit risk. So you are lending money. So debt may typically you are lending money. Equity may you are becoming owners in businesses. Debt may you are lending money and the borrower is taking money in return for an interest. Now, whenever you are lending money and you are getting a higher rate of interest, it means that the borrower is not being able to borrow money at market rate of interest, let's say from the banks or NBFCs, etc., because of which they are willing to give you a higher rate of interest and asking for capital from you. While all of these products, are absolutely legal products, have a place and space in the portfolio, but they do come with credit risk. So credit risk means that there is a risk that the borrower may default on repayment, right? And if a credit risk event hits you, then your entire investment can go down to zero. And this happened in 2018, when we saw a couple of financial institutions, actually getting busted. There was a credit event. There were defaults, a series of defaults. You can Google DHFL, ILNFS, and the whole NBFC market was, had completely dried up for liquidity, and it had led to a series of subsequent defaults that were happening, and a lot of people who had invested in NCDs, bonds, FDs did lose a lot of money at that point in time. So these events might happen once in a while. Also, one thing that's coming to my mind, a lot of people invest in cooperative banks, right? And they have a lot of their savings account is in a local cooperative bank. Again, please understand, try and be with nationalized scheduled banks. Cooperative banks come with a lot of risk around their size, credit worthiness, etc. And there have been quite a number of cases where cooperative banks have not been able to take care of money, and you've lost money. On this note, important to understand that irrespective of the amount of money that you have kept in FD with each bank, the government only insures 5 lakh rupees of FDs per bank. So if you have a 25 lakh FD in a cooperative bank and the cooperative bank goes bust and it shuts down, you will only have the potential to get back 5 lakh. So there is a long-standing myth that FDs are absolutely safe. That's not the case. FD insurance in India is only 5 lakh per bank. So if you have a massive chunk of FDs or a massive chunk of balance in a bank, and this includes not just FDs, but your savings deposit as well. So if you have a lot of money in a particular bank, make sure that that is in a nationalized scheduled bank to actually reduce your risk and not in a cooperative bank. Coming to equity, the most known asset classes within the products within equity is either you buy stocks yourself or you invest through mutual funds. I will come to a third category as well on the next slide. Now, mutual funds, of course, most of us would be knowing. They are a pooled instrument. It basically says that, look, you want to get exposure to stocks, you want to get exposure to the equity market, but you want to also not concentrate, because when you go and buy stocks, you will probably be able to buy 10, 15, 20 stocks at a time. And because you may not have the time to do extensive research, spend time reading, also may not have the interest to understand the space very well and keep yourself up to date with all the knowledge and the updates that are happening, it is quite possible that you invest in stocks, but then nobody is looking after that portfolio. So a lot of people we meet say that, I have a 50 lakh stock portfolio. That portfolio has, in a lot of cases, more than 120 stocks. And they don't know what's the return that is getting generated on that portfolio on an average annual basis. They do not track that. They do not know when to sell, what to buy more, what to sell, how much. So none of these decision making happens because either they have not been able to spend the time or they've not had enough interest in the subject matter. So that is why most people, we recommend that if that's the case, mutual fund is a great way to start taking exposure into equity markets. You invest in a pooled instrument, and that fund manager will take all the pooled money and then invest in the stock market. So even with a 10,000 rupees monthly investment, you end up getting exposure to, let's say, a basket of 40 stocks or 50 stocks, which is being managed by a fund manager who has been designated to do this full time. So you do not need to take a lot of those buying and selling decisions. The only decision you need to take is probably which mutual fund I should be invested in, what is suitable for my risk appetite and my goals, etc. The third way in which you can do stock investments is by working with a stock advisor who is managing stocks through a demat account, or a PMS player, which is portfolio management services. Some of you may have heard about them. So these are entities which for you are similar to mutual funds, but they are slightly different from mutual funds in the sense that they usually hold a concentrated basket of stocks. The basket is usually very different from the kind of portfolios that mutual funds hold. So the reason why you may invest in a stock to a stock advisor or a PMS product is with the objective of taking slightly higher risk with capital to achieve returns which are higher than mutual fund returns. Because if you are getting returns which are similar to mutual funds or lower than mutual funds, it does not make sense to invest in stocks directly, because mutual funds otherwise are a very tax efficient vehicle, right? Whereas stocks is not a pass through vehicle. You receive dividends, they are taxable. Capital gain is taxable. All trades, there are transaction costs of executing in stocks. So the only reason you may have a stock portfolio is when you think that this particular advisor or this particular PMS has the potential to do better than what the mutual fund portfolio can do. And the reason I say this is because I'll just show this small data point. And you can actually collate data across the industry for stock portfolios and PMS players. And let me give you a caveat that not a lot of PMS players have been able to outperform mutual funds. You need to be very, very careful about the advisor that you select for your stock investments. So these are two products that we have been running for the last few years, and I have compared this with a category of mutual funds called FlexiCap category. These are actual returns, by the way. And then I've also compared it with one of the best FlexiCap funds in the industry, which is Parag Parikh FlexiCap fund. This is one of the best FlexiCap mutual fund within the FlexiCap industry. You would see that, in the short term, over a 1 month, 3 month, 6 month period, you would see that stocks could be a lot more painful. For example, one of our products has given minus 17% return over a 1 year period. And whereas Parag Parikh over the same period has given a 10% return, positive return. So stocks could be very painful in the over a short term period. But when you look at over, like longer term periods of 3, 5 years, 7 years, 10 years, they should have the potential to significantly outperform the categories. Because if they don't have this potential, then stocks do not merit an allocation at all in your portfolio. So in case you are working with an advisor or investing in stocks yourself, it is only justified if you're able to outperform the mutual fund portfolio. Otherwise, you should not be investing in any of the stock products or doing stocks by yourself. Just go for a well diversified mutual fund portfolio. So so this quote is very interesting. In the long run, a portfolio of well chosen stocks and or equity mutual funds will always outperform a portfolio of bonds or money market portfolio. And also it will outperform, and in the long run, a portfolio of poorly chosen stocks will always underperform even the money that you leave under the mattress. So, the stock investments come with a double-edged sword. If you're able to, do your stock investments well, you've been able to choose the right kind of funds, the right kind of mutual funds and or the right kind of stocks, you will be able to significantly outperform money lying in your PPF or your FDs, and in a lot of cases, even real estate and gold. But if you have taken poor allocation decisions in the equity asset class, whether it is mutual funds or stocks, you might significantly underperform all of these other asset classes. So it is not it's not just asset allocation that is important, but within asset allocation, it is also important to be able to identify the right kind of funds, the right kind of names that you are actually invested in. Gold, again, I don't think it needs a lot of description. Physical gold, we all know. It could be jewelry, biscuits, any other form of physical gold. The challenge is only cost of storage, risk of theft, and but it is very suitable, if you feel that there is a country risk or a governance risk, that tomorrow my government can go bust. And then it becomes very, very relevant to have physical gold, because physical gold is the only thing that you can really pick up and just go out of the country. Financial instruments will all go bust if the government goes, when the country goes bust, right? So that way, physical gold is very important. But otherwise, because of the challenges of physical gold, actually investing through gold mutual funds, gold ETFs has become extremely popular. There used to be an instrument called sovereign gold bonds, which was our favorite till a couple of years back. But no more sovereign gold bond issuances that are coming from the government. So any financial investments in gold is also merit worthy, as long as it is used for diversification of your portfolio. Real estate, again, there can be residential, there can be commercial. For residential, it could be your own house that you are buying for your own living, or it could be an investment that you're doing for rental income. Normally, the way residential real estate currently is panning out across India, while the prices are shooting up significantly, but if you talk to a lot of investors have not been able to sell at a price which is kind of prevailing in the market, and the returns haven't really been 10-12% kind of double digit returns. So of course, the thing with real estate is that it can be extremely pocketed experience. Some people might generate a very good return by virtue of the location or some construction that has happened there. So you need to be extremely careful about real estate investment, in the sense that because every single investment takes a bigger chunk of your capital, you need to make sure that that investment, you have reasonable amount of confidence on that investment for yielding the at least 9-10% kind of a average annual return for you over a longer period of time. Commercial, similarly, the risk is normally of tenancy. If you're owning a shop, you have to be reasonably sure that the shop will be occupied, the rentals will keep coming in, the location is great, so on and so forth. Land, again, has a very different dynamic. The only challenge with land is normally if you end up buying a land which is not within your proximity area, and you are not being able to manage, in a lot of cases you will see encroachment issues, legality issues, which is very difficult to manage on a day-to-day basis. So if you're able to identify the right kind of land parcel which is within your manageable proximity, it can merit an allocation in your portfolio. But again, you need to think about what percentage of your net worth is allocated here, because if, let's say, 70-80% of your investment is allocated in residential real estate and land, etc., then you are taking a bet on just 2 to 3 properties actually creating wealth for you. And in case they don't do well, you will not be able to move your wealth needle over a 10-15 year timeline. So while each of these asset classes have their own merits and own challenges, there is absolutely no asset class which comes with no challenges and is a perfect choice for everybody. You need to understand what is more fitting as per your situation, your circumstances, your goals, and your time frames, and then take a call in terms of what you should be investing. That's it from our end. Happy to take questions, if any.
That was an excellent presentation, Mr. Shruti Agarwal, and it had a elaborate information about all the different asset classes. So we'll be discussing obviously more at the physical session at the YOSI Con, and how to when we are talking about targeting a portfolio of a particular amount. So at least few of my questions would be that how a person should decide to have asset allocation in different options according to their age. Like suppose somebody is like a 30-year-old doctor, how much equity he should have, how much the portfolio should have how much percentage the debt should be there, how much gold should be there, something like that. Can you throw some light on that?
So my initial views on that, Dr. Nikunj, would be that if you actually Google, it would say 100 minus your age should be your equity allocation, right?
That's
So that's a thumb rule.
thumb
The
rule.
reason that thumb rule has been defined is because it says that when you are young, you are capable of taking higher risk and you're also capable of letting your money grow for a longer period of time. So if you remember in the last session, I was talking about this particular client who was 52 when she came to us, and she was a salaried employee, did not have a retirement corpus built in, and she said that I only have 8 years to now build my retirement corpus. Now, 8 years is not a significantly long timeline for equity to really compound and do wonders for you, which is why it is said that the younger you are in a position to take a higher equity risk. Having said that, it is not necessary that everybody follows that. What is important to take note is that equity definitely merits allocation, at least 30 to 40%, if not 100 minus your age. There should be minimal allocation to debt. It should only represent what you need for your emergency capital and any purchases that you need to do in the next few years. For example, for a lot of young people, they might say that, okay, I need to spend a certain amount of money for my wedding, or I need to buy a car. So all of those also need to be taken care of. So that money cannot go to equity. So the equity proportion ends up becoming lower as compared to 100 minus age, right? But again, there would be a scenario where somebody would say that, look, I have only a limited capital and I am very confused if I should do mutual funds or I should go and buy my first house. Now, this is a very debatable kind of a situation. Personally, I feel that, you should buy a house. You should not buy a house by having zero allocation to mutual funds, because by the time you're done with EMIs and you kind of like actually get surplus capital, you are already 10-15 years into your journey, and then again you lose out on that compounding capital. So if you're able to create a balance between these two, then you're able to take some equity allocation and then you can have allocation to other asset classes. So frankly, to answer your question, for every individual it could be a slightly different scenario depending on their responsibilities, their goals, and their preferences.
All right, correct. And because we talked about the debt also, so are there any better instruments than just having a fixed deposit for your, even for your like debt related instruments, debt related funds like emergency fund or whatever you are keeping in a debt instrument? So anything better than FD, and what are the taxations on that, stuff like that?
Now, because you want to take this?
Yeah, so hi Dr. Nikunj. First, on the first question, also, I wanted to just add, see what happens is that, like in any profession, a lot of times people don't give adequate time which is required for personal finance. So, what I have felt is that people think that this is something जो मुझे करना है side में, या फिर they take decision without giving time. But after being in this profession from last 10 years, what I felt is that this needs some kind of time from the investor itself, where he tries to understand himself, he tries to understand his financial goals, and once he devotes this time, whether with himself or with a professional, he will get some answers which will help him with the allocation. So if you see a lot of people who are in their 50s and 55, like they need money only for inheritance. So inheritance can be their major chunk which they want to do. Now they don't think about that, and they allocate resources which is not in line with what is their need for the next 10, 20, 30 years. So personal finance is sometimes being neglected, just like health. People don't think that what they have to eat, what, because sometimes in your day-to-day life your other priorities becomes more important. So the allocation is predominantly decided by what is your actual need for the next 1, 5, 10, 20 years, and what are your internal desire with the money that you hold. So that defines your asset allocation. Secondly, on the debt side, there are definitely some better alternatives. See what happens is, in this case also, a debt fund versus an FD is determined with the investor's tax incidence. So earlier, what was happening is that debt funds have some had some more advantage. Now they have relatively lesser advantage to FDs, but still the bigger difference between a debt mutual fund versus an FD is that in an FD you are charged on an accrual basis. By this, what I mean is that even if you don't redeem an FD, if you don't do anything with an FD, in your ITR, you will be charged whatever interest that you have earned that year. So even if you do a 5-year FD, at the end of 1 year, whatever is your accrued interest, you will be charged. On the other aspect, there are similar kind of risk, I would say, which is being taken by some debt funds which allocate only to sovereign, which is Indian government rated securities. So you are not taking any kind of extra credit risk, but your taxation moves from accrual. I hope everybody like accrual is accrual to only when you sell. So that is the advantage which you get through some of the instruments where you can change your taxation. Now, what I have observed with my personal investments and managing some of our client investment is that we need some liquid money, but it may not be required sometimes even for 3 years, 5 years, 7 years also. And it is just to cushion our investments, just to give us comfort that there is certain kind of corpus which is available immediately at a 24 hours notice. And if this money keeps like if this money is lying in a debt mutual fund, you start getting benefit of deferred taxes, where you are paying taxes only once at the time of redemption rather than paying it every year, even if you are not redeeming. So there are to cut your question and to give you a short answer is that there are definitely better investment avenues available, better than FD, with a similar kind of risk appetite. But one has to understand that at what circumstances it is useful and how you should allocate between them.
Also, I
Thank
would just like to add that, in a lot of cases, I come across people who say that I like to keep a larger amount as an emergency capital. I mean, larger amount, by larger amount, I mean 30, 40 lakhs as well. So they would say that I like to see 50 lakhs available as liquid for me in case anything happens, because I wouldn't want to go take a loan or go, ask money from everybody. If your emergency fund requirement is a very large amount, then there are also funds which have a slightly higher risk profile, but also have the potential to do better than bank FDs, both on pre-tax and post-tax basis over a 3 to 5 year period. So there are some fund categories like that as well. So for a lot of our clients, we also recommend that your part of your emergency fund can be in bank FDs or debt mutual funds or arbitrage funds, which are absolutely similar risk profile with very minimal volatility. But a part of your emergency fund also be in slightly higher risk funds. And by risk, I mean volatility, not so much about capital loss. Um, because you feel that that emergency may not really happen and that capital may just stay around for 3 to 5 years. So you may end up getting post tax even 7.5, 7.5 kind of a return, which in case of an FD, post tax would be 4.8, 4.9. So there's a significant amount of difference there.
Nikun sir, can I
Yes,
ask?
yes, definitely. Please.
Thank you, Mr. and Mr. Prakash. I have a few very interesting questions for you. This has got to do more with behavioral finance that I'm seeking your answer in. So the first part is about the taxation part. So being a young ophthalmologist and moving the point that Mr. Vikas was mentioning, we don't have the indexation benefit anymore for the debt funds. So how is it that you're going to convince me to stay with the debt fund? Because anyways, I'm going to scale up in the tax bracket, right? So let us say I'm being taxed much lesser when I'm earning lesser and the 15 or the 20% bracket, rather than getting taxed for the same returns later on, because indexation benefit is now being removed with the debt fund. So, and along those lines, my doubt is, can you give us some idea about how to approach asset allocation from a taxation benefit? Like we just spoke about debt fund for a starter, because now inevitably all of us are some way or the other being pushed into the new tax regime. Uh, Now is the tax filing season also. And even from my own personal experience, I just, I was discussing with my auditor and they're saying, let's go with the 10 EA and, change over to new tax regime. So, of course, we all have those calculations of 1.5 for the ETC and all that, but your perspectives on asset allocation purely from a taxation perspective and what are the perks of, allocating it that way. So if you could shed some light, like the debt fund point that you just mentioned.
Yeah, so first I will mention your question on debt fund. I think you are well aware about what is happening on the debt fund side and you have an informed question. Now, what happens is that first, if you invest in a pure debt fund, which is say where there is no indexation benefit and there is no tax advantage also. So now what has happened is that if you're doing investment in an overnight fund or a liquid fund, which is say 100% in say government securities which are maturing in less than say 90 days, so they have that kind of profile. So if you're doing that, the tax advantage is minimal. And if say suppose you are in 15-20% tax bracket, you are saying that going forward this will be taxed at higher tax bracket, so that is something for young people. It is not something which is meaningful also, so they should not complicate things and they should even go for an FD. So there is actually no problem in that. But what happens is that, like Shruti mentioned, there are some debt funds. What they do is they invest 65 to 70% of the corpus in say government bonds. 20-25% they do an arbitrage kind of allocation where they don't take any risk. 10% they do equity. In that kind of allocation, what happens is you are taking a 10% market risk. If you're taking a 10% market risk, even if the market say goes down by say 30%, like it is a COVID kind of a period, your capital will not go down. You will see a 2-3% kind of volatility in your return. So instead of say seeing a 7% return, you will see maybe a 4-5% return. And that too for a short period is what we will expect if there is an extreme event. In those kind of funds, what happens is after 2 years, you are being charged at 12.5% only. So what happens is that if you have some allocation to those kind of funds where you are taking very, very low risk, because ultimately you are taking no credit risk. So there is no credit risk, everything is sovereign. There's a 10% equity risk that you are taking, but that 10% equity risk actually volatility acts in your favor if you are even there for a shorter period, because when there is an event like COVID, they will again go back to their strategic asset allocation, which is from, because if market falls so much, their equity allocation will further go down from 10, it will go to 8, 7. So they will actually fill up more equity at lower levels. They will bring it back to 10. So they will be buying again at lower levels. And if you stick around for 6 months to 1 year, and if the markets recover slightly also, you will start seeing that you are getting that 7.5, 8% return. And on those kind of investments, you are being charged 12.5% after 2 years. So this is how we do a lot of our client investment, where we say that if you have any allocation which you want to do to a debt asset class, and where your horizon is say for more than 1.5, 2 years, this becomes a good product because the volatility is very low and you get tax advantage. So this was my answer to your question.
Percent is what we pay the fund manager, is it?
The 12.5, say suppose your 1 lakh becomes 1,30,000. So on that 30,000 gains, you will pay 12.5%. But
Oh,
if you were in an FD on that 30,000, you would have paid 10,000 rupees. So now with larger sums of money, the advantage becomes, so there is an arbitrage of 20% versus a normal FD or a normal like debt fund. If you stick around for 2 years and like this is, I'm talking about people who are in the highest tax slab. So this
got it.
becomes useful for them.
And one more place where I need both of your help is to convince us to spend less time on reading, stats and stocks and everything, and spend more time on our career because I've been on both sides and I choose the latter now because this is very important for us. Maybe a year back or maybe a year and a half back, I subscribed to every possible you know uh, economics magazine and whatnot. And that is when, see, of course it gave me a breakthrough and sort of gave me some basics, no doubt about it. But at one point I started realizing that maybe I have interacted with people who've turned from ophthalmologists into traders and investment portfolio managers. And there are certain people who are standing on the brink, and I was also standing on the brink. Okay. Because suddenly everything starts to appear very, gloomy. And I mean, not gloomy, I would say very positive. You work less and sort of gives a very vague picture of making more money. So then that is when I was told and I was advised by my mentors to not get carried away, leave alone trading. Trading is a completely different ballgame. Even with investing, we should not be, carried away and focus on our careers to start with and leave the job to you guys so that we can peacefully focus on our career. But also let us know what to do if we get some lump sums in between, because we operate, so this is some part of behavioral finance which I really need your input on, because many people I know of are really getting carried away by this, thinking they are going to become fund managers or what, I have no idea. But within my circles, as doctor friends, I know of people who think they can make more money out of their portfolio rather than out of their careers, which is very alarming to.
Yeah, so I have a lot of things to speak about on this. So what happens is this
I
is an
think we did something
evolution.
about this in YOSICon also, just to give you a heads up.
Yeah. That is actually, this is a very nice question, and it is very relevant. Sometimes it is not being appreciated because it looks like a generic question, but it has a lot of implication. So first, I'll tell you that even I'll tell you. So there are two kinds of investing which happens. Okay, one investing, what you are doing is on a personal net worth, and second is what you do within that. By this, what I mean is, say, suppose you have a corpus of 100. In that, you decide in which asset class you will put what money. So this session was about that. And after that, within that asset class, how much returns you generate within that. So by this, what I mean is, say, suppose you have 100, you decided I'll do 15 equity, 13 debt, 20 in real estate, something like that. And then in 50, what you are doing in stocks or whatever trading, in that 50, what percentage higher returns that you will generate. This is the two major decision that everyone has to do if you are talking about trading, investing and all. Now, if you read any literature, so it says that 90% of your returns are determined by actually asset allocation. So what happens is people don't focus on how much you're allocating to which asset class. What they will do is that if they have 1 crore, they will allocate say 20 lakhs to stocks, and on that 20 lakhs they will want to generate 30% return. And on their 80% of their wealth, it will be lying in say PPF, FD, real estate, where they're not monitoring the returns. They're focused on that 20 lakhs, and at that 20 lakhs they will want 35% return. Now if you start understanding this, that what you make on your entire 1 crore is what you get home. It's not that what you make on your 20 lakhs, that is the only thing that matters. So this is one thought process which everyone has to understand, is that on your entire net worth, how are you moving the needle? If you are very good, and if you are actually able to outperform markets, I'm not talking about you, I'm talking about me also. So try to understand that what the dilemma that you're talking about, it is not relevant to only doctors. This is a very generic dilemma which is applicable to all of us. If we say that we can deliver say 20-25% returns, we can deliver better than fund managers, then our allocation to that asset class, or that where we are allocating our time, should have the maximum allocation, because we are saying that we will outsmart the smartest people. That is why we are giving our time. That is one thing that has to be focused. So if you are right, your allocation should be backed by what you are doing. Point number one. If you're not able to do that, how you get that answer? Second, we come to that. See, in this kind of industry, the only way to get answer is that you have to measure. So what happens is that as young investors or investors who are trying out things in the market, there's no wrong, because investing is a field which can be only learned by practicing. So it is not something which can be learned by reading books. But if you are practicing investments, and if you're not measuring your returns against various benchmarks, so if you say that I am doing better, so you are doing better, you should at least, you cannot only take investment decisions, you have to also take measurement decisions, that I am doing better in terms of returns, also in terms of risk also. So you should calculate your drawdowns, you should calculate, there are certain things. So you have to evolve to that aspect also, that you are able to measure what you are trying to say. If you're not measuring, then you are trying to entertain yourself. And if entertainment is what you're needing, then you don't need help from anyone else. It's more about your self discovery.
Because Mr.
Also
Vikas,
on
why I'll just add a point here.
Hmm.
You know what happens to people like us? The mistakes we do is we try to take shortcuts to get it. See, I'll tell you, I'll be very frank with you. How coming to that measurement point, all I do is if I open my portfolio, I am able to see only two things. One is whether it's red or green, okay, my returns, which is very, very crude. Second is even if it is in green, all the data I have in my head is what is Nifty doing, Nifty 50 doing. And in fact, even if I have an allocation in my small cap fund or mid cap fund, I don't have the time to see whether it's crossing its benchmark. All I see is my portfolio working better than a Nifty 50, in spite of having invested in mid cap and small cap, which is absolutely absurd. And coming to the stock portfolio, all I can do at this point of time as a young ophthalmologist is just go with recommendations. I do not have time to read the call reports. I do not have the time to, go through a previous, call, whatever the lower part of any analysis sheet. So what I do, I see for ratings. This is the point where I want you guys to highlight it to the young doctors or anybody, youngsters, is that we are really easily carried away by recommendations that come from God knows what source. You talk about magazines, you talk about WhatsApp forwards, whatnot, but that is the easiest way I can think of in investing in a stock. And I mean, I'm not saying I've lost a lot of money, but at least I've invested in too many stocks, then had to cut down on my portfolio, and it's completely a mess. So this is exactly the point where I
So,
I
yeah,
should.
so I'll just add to that, Dr. Niranjan. So, before to what you said, also what happens in a lot of cases that we see when people come to us, and again, like Vikas said, this is not a doctor-specific problem. This is a phenomena that is across the spectrum. So, what we see is that while you said that you are able to see only red and green within the mutual funds, you are only able to see what Nifty 50 is doing. One more thing that people see is only absolute numbers. So what they say is that, what, I invested 50,000 here, 75 में बेचा, 25,000 का return है. They don't monitor XIRR, that how many buying selling decisions have you taken, and net what is the average annual return that you have generated out of all the decisions that you have taken, which takes into account timing, takes into account allocation. So you rightly pointed out that people operate on tips, right? Now the thing with tips is that let's say somebody told you that you should go and invest in Swiggy. The problem is that right now you know that you should invest in Swiggy, but you don't know how much you should invest in Swiggy. Number one. Number two, once you have invested, you don't know what to do with it, when to sell it, because the person who was giving the tip just gave you the buying tip, and you don't know the science behind it or the logic behind it. So ultimately what happens, this is why your portfolio becomes a mess and has so many stocks or so many funds. I recently audited a portfolio which had 52 mutual funds, and within the 52 mutual funds they had 8 Nifty 50 index funds. HDFC Nifty 50 भी है, SBI Nifty 50 भी है, ICICI Nifty 50 भी है, and the client is thinking that it is actually diversifying. So what I'm trying to say is, by just the inability, the decision paralysis actually leads to the reason why your portfolio becomes a mess. And a lot of this will happen during bull markets because everybody is making money. You buy any Tom, Dick, Harry, you are making money. So in bull markets, there'll be a lot of new advisors who come into the market, and then they'll be a little quieter during the bear markets.
In bull market, everybody becomes a fund manager. So yeah,
I have just one more thing to add. See, what happens is, how I think about it is that you have to also have a long-term mindset. So by this, what I mean is that if you're doing something on 10 lakhs, you should know that you can do this on 5 crores. You can do this on 2 crores, because on 10 lakhs, you will not have any impact to your financial life. But yeah, if you're doing it right on 2 crores, you will have an impact on your financial life. So anybody who is young, he has to understand that what I am doing, whether it is replicable or not on higher sums of capital. If it is not replicable on higher sums of capital, actually you are just devoting your time and you will not be able to add value to yourself. So whatever you are doing, you have to just think whether it can be replicated on 5x capital, whether I can do this on 10x capital. Because when you are managing any money, this is one of the rules, that you'll always be managing higher sums of capital year on year, because you will be having some savings, you will be having some inflows, your portfolio will also go up. So if your thought process is not scalable, And if it's not scalable, then you should always rethink, can I do it on 10x capital or not? So that is, these are some questions that an investor has to answer himself. Somebody can only give some kind of gyan, or that can be one way communication that can come from here, but this should just have a thought provoking kind of thing, that whether these are the answers that you have to answer for yourself, and if no is coming, then you need to rethink.
I really don't think we
Or
think that much about replicability into a 2 crore at all when we invest our. And one more point. Please make a note of this also. Decode the word of risk for us at YOSICon, because we see risk from a very doctor's point of view. Okay, because we do defensive medicine and we don't see any opportunity in risk in medicine. Okay, at least very little. So if it's a complicated case, yes, we do it, but we give guarded prognosis. Meaning we tell them, see, this is what is going to happen. This is what is going to happen. So we do evidence-based defensive medicine. So the word risk to us is really this thing. I mean, to replace it with volatility is one way to go about it. But what I mean by decoding risk at YOSICon is telling them that, see, risk has its opportunities, and that again is one place, because many of our friends are still under the impression that real estate has no risk. Like you mentioned, FD has no risk, which we just happen to burst the bubble. So if you can allocate a little bit of time on that, I'm pretty sure at least we'll end up convincing people that equity has its role in our portfolio. Because even till date, there are many people who feel equity is directly equivalent to risk, nothing else, nothing else. So I think we really need to highlight on that part in our program also.
sure. So also, Dr. Niranjan, just to add to answer your question about getting lump sums in between.
Yeah.
So that is not a challenge in investing. It's not like SIP is the only way to invest. You can always figure out a way to invest lump sums also. So if you're working with an advisor, all you need to tell your advisor is, this is the amount of money that I have to invest now. And if your advisor is good, the advisor will tell you how you can invest that money at that point in time. How does it fit into your goals? For example, if let's say you feel that I would have ideally wanted to do SIPs, but I've received a lump sum, it can be converted into STPs, which is
Yes.
systematic transfer plan, where you can invest it in an arbitrage fund. From there, every monthly the installment is going into equity fund. So there are ways to convert it. These are just modes of investing. So lump sum versus a monthly cash flow does not really determine anything. I think what everybody needs to think about is, what percentage of my annual income am I investing and adding to my kitty? That's also important. So it's not so much about whether I'm doing an SIP or a lump sum investments. It's about what is my investing rate on an annual basis. If I'm earning X amount and I'm investing Y, what is that Y as a percentage of X? And how does that add up over a 10-20 year period?
The year and a half that I was mentioning before, I used to think of what stock to buy with that little 5,000, 10,000 I used to get. But nowadays, just jao UTI Nifty 50 में डालो, या कोई भी Nifty 50 में डालो, बस next काम शुरू कर दो. That's the way I work nowadays, considering the amount of other things that we are doing. Of course, if people do have time, they can explore options. But yeah, this is a very nice point, Shruti, that you
What you are doing, you are, I would
very
say,
conservative.
90% better than the, like, you are in that 10% or 5% investors, because if you're able to automate it, nothing like it. And where you are putting it is because at the end of the day, everyone plays around with money, and if you're able to do what you're doing, that in itself will solve the purpose.
Really, automation is the only way I see comfort
That's
in.
the only way I'm telling you. And the lesser you see, the better you will be. As I, it's all about that.
It was a very nice session, Mr. Prakash and Shruti. Thank you so much. Nikun sir, over to you. My doubts, I think.
So, a lot to discuss actually, and I was really happy for your questions, because a lot of people think that, I mean, not a lot of in our field, people start, investing, and once you get that, taste of money being generated very fast, especially in the bull market, and you try to think that, okay, let's just
Too
forget,
taxi, sir. It's really too
let's
taxi for me
forget,
to.
yeah, let's forget ophthalmology and focus on this. So important thing is, what message we should also spread, that being in for our, at least our group, because we are all young ophthalmologist group, that you need to focus on your primary source of income by doing good at your career and have that constant cash flow or income or whatever you want to call it, to be able to save first, then invest in stock market to get that extra wealth which stock market is able to give to a lot of people. The primary source of income cannot be replaced by just doing stocks or trading, or for us, because
For
we have
us,
given 14 15 years of our life to learn ophthalmology and not stock picking. And even after doing, even professionals like we have here, they will still, I mean, they also nobody can say that, yeah, I'm the best stock picker, because it's not possible. So
Yeah.
primary source of income, we need to focus on our career, and whatever you are able to earn, you need to invest from that at whatever portion is possible for you, and that will help you to be financially independent, at least in future. Retire early का तो सवाल ही नहीं है, because I don't think I can be retire and sit at home, because I'll be working till the time my hands are working. Because for the passion of the work and ophthalmology, that is different thing. And so, yeah, we should always focus on the primary source of income and ophthalmology first, followed by stocks, mutual fund, etc. Whatever we can do in our
still,
for our
because
financial part.
fire being overrated is another area I think you should focus on for us,
Yes.
because I mean, I'm overloading you with content, but I think these are really hot topics for us, which we would like to hear from you.
Yes.
Sure,
So,
sure. We take this feedback.
yeah, and definitely all these topics which Niranjan has suggested will discuss that at the YOSI. So now we'll be now next we'll be meeting physical at YOSI. YOSI is happening from 5th to 7th September at India Habitat Center, New Delhi. And there we are going to discuss goal-based planning for a 30-year-old doctor who is we have taken a 30-year-old. That is where we generally start our career in a professional life after training, fellowship, everything. And how can a 30-year-old doctor target a 10 crore portfolio through asset allocation and disciplined investing? So asset allocation is the first word we are using here for the planning, and the second is disciplined investing. You need to be disciplined. You need to focus on doing it on a auto mode, and then have the patience to build that corpus which you are targeting. So I would like to thank Mrs. Shruti Agarwal and Vikas Agarwal for joining us today, and we're looking forward to look forward to meet you at the UC and if anybody wants to, I mean, who wouldn't want to target a 10 crore portfolio? So that session is not to be missed, and I'll see you everybody at UC. So thank you so
Thank you.
much.
Thank you. Thank you, Dr. Nikunj. Thank you, Dr. Niranjan. Thank you.
Thank
Looking
you.
forward to meet you guys on the 6th.
We are
Yes.
more eager.
Yeah.
Perfect.
Okay. Okay. Thank you.
All
Thanks so
right.
much.
Thank you. Good night. Good night.
Bye. 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 Good night. Good night.
Thank you. Good night.